The concept of partnerships in the banking world is hardly new. With fintechs, we see three types of partnerships forming. The first is a very traditional one, which we've been doing for ages, which requires us to tap into the innovation and technology developed by fintechs to solve long-standing banking problems. These can be problems in KYC, AML, customer service, all of which require sifting through big data. And it obviously helps with the advances in machine learning that we are seeing more and more developments in this space, and we are seeing more and more pilots and engagements with fintech firms that fit this traditional model. The second bit is where a bank offers white labeled service or a product which is owned by a fintech. So in this instance, the product and service is developed by the fintech, but it is marketed to the bank's customers through the bank's sales and service channels. Many new asset management firms, loan and savings providers, buy now, pay later firms fit the bill of this type of partnership. They are really interested in Standard Chartered because we bank Asia, Africa, and Middle East, which are among the most populous continents, and the profile of our customers fit the profile of the fintechs really, really well. The third type of partnership is where a bank provides the banking infrastructure for the fintech to develop products and services. So the customer and the customer experience is owned by the fintech, but its products are developed on a series of services that are provided by their banking partner. As financial technology matures and services are getting more and more ubiquitous, we are offering financial microservices. This type of engagement is clearly on the rise. We've received a lot of inquiries in this space of late, and I'm very proud to say that across all three types of partnerships, Standard Chartered is playing an active role engaging with the fintech community. I will share not one, but two very successful examples. The first one, we have helped a fintech develop merchant wallets. And this product underlines their overall proposition of running some of the world's largest e-commerce websites in many different countries. So the whole financial plumbing and infrastructure around payments, collections, repaying loans of merchants, repatriating profits of merchants, etc., is underpinned by Standard Chartered Bank. And this allows the fintech to offer this service and the service promise to their merchants that operate on the e-commerce websites. The second example that I want to point out is one that's really close to our hearts at the bank because it really fits in well with our Here for Good promise for communities. In this, what started out as a pilot on blockchain has now moved into production, and a very successful one at that, where we are making cross-border remittances with a fintech at extremely low cost. So this is targeted mostly towards white-collar workers that are sending really small amounts of money back homes to their families in most of these developing markets in Asia. We've been able to execute this at minimal FX charges and extremely low transactional fees, something that was almost unheard of in this part of the world. Actually, the answer to that is quite symmetric because what fintechs look for in a bank are also what a bank should look for in a fintech. And let me explain. So first and foremost, I feel that there needs to be a little bit of history between the two parties of working closely with each other. The one thing that is detrimental to a partnership is surprise. And a little bit of working history and understanding of the cultures, engagement at the senior levels, etc., helps in a significant way to reduce surprises. So that's point number one. Point number two, once we have developed some experience working together, we need to understand each other's visions and perspective, especially in the context of the partnership that is being executed. Fintech firms often want to run fast, capture clients, sell product, whereas banks want to do all of that, plus manage risk and make sure that there are controls in place so things don't fall off the rail in case things go wrong. Now, often that can be seen as opposing objectives, and the only way it can be balanced is by understanding the perspective of each party. And this is really key because it will happen in a partnership that one party thinks that the other one is not working fast enough, and vice versa. So that amount of understanding of perspective and vision really helps. The third, and in my opinion, one of the most stronger ones, is to avoid taking strong positions. And this is something that we hear in the press all the time, where fintechs accuse banks of being large monoliths and extremely slow at implementing things, whereas banks accuse fintechs of being cowboys conducting regulatory arbitrage, and they end up in positions where it is almost impossible to meet midway. So one of the most important ingredients, and the hardest one, is to actually jettison all of that thought and come to the table with a clean sheet of paper with an attitude to learn from each other. I can assure you from experience that this is much easier said than done. Now, to me, those three are only the initial ingredients necessary to start a good partnership. A good partnership also takes a lot of effort and hard work along the way. There is no single institution that is good at everything they do, and that is worth recognizing. Because in a partnership, the objective must be to focus on the strengths of each other and grow the partnership on that foundation.